Warren Buffett said he could make 50% a year with small money. Not 10%, not 20%, 50%. Here's the problem. 99% of stocks will never get close. Most will lose money. Some will even go to zero. But there's a system that Buffett has used to find the 1% of stocks that actually deliver. Like when he bought Apple in 2015, everyone said he was too late. The stock had already gone up and it was all over. Tech wasn't his thing. Today that investment is over 10 times what he bought it for. I'm Jack, and over the last 7 years I've studied Warren Buffett and other legendary investors for how they pick the best winners and avoid the losers. Today I'm breaking down the exact 5 tests they use. By the end of this video, you'll know how to avoid the 99% that fail and position yourself to be able to find those top 1% of stocks that will change your life. Let's go. Test 1. Can you predict it? The first test is simple. Can you predict what this business will look like in 10 years' time? If not, stop, move on. It doesn't matter how exciting the business is. And this is what Buffett calls your circle of competence. Here's how you test it. I call it the 3 C's. Consistency, competence, and continuity. Competency. Do you understand how the business makes money? Not the stock price, the actual business. How do they get customers? How do they sell? How do they buy from them? And if you can't explain it simply, you don't understand the business well enough. Consistency. Has this business been doing the same thing for at least 5 years? So look at their revenue, their profit margins, their cash flow. Do you see any patterns? And if the numbers jump around wildly from year to year, it's not really an investment, it's more of a speculation. Continuity. Is the business staying the same going forward? Are they trying to solve hard problems? Are they entering new markets? Are they doing things that they've never done before? If yes, it's most likely a red flag. Let me show you how this all applies to Apple in 2015. When Buffett looked at Apple, here's what he saw. Competency. Apple sells premium phones, computers, and tablets to loyal customers who pay more for quality and design. Simple. Consistency. Look at their track record. The iPhone launched in 2007. By 2015, Apple had 8 years of consistent iPhone sales growth. Year after year, people bought new iPhones. So predictable pattern. Continuity. Was Apple trying to reinvent itself? No, they were doing what worked. Keep improving the iPhone, keep the ecosystem locked in, and keep customers coming back. Buffett could look 10 years into the future and say, yep, people will still be buying iPhones. And that's the power of the 3 C's. Now compare that to a hot tech startup. They might be growing really fast at the moment, but can you actually predict where they'll be in about 10 years' time? Probably not. They're pivoting, they're experimenting, they're burning cash. They most likely haven't even got to profitability yet. That's not investing, that's speculating. Here's a quote from Warren Buffett's 1996 letter. You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Many investors fail this test because they chase after excitement. They want the next big thing, the next 10x moonshot, that hot stock everyone's talking about. But Buffett's looking for boring businesses. Businesses so consistent and predictable that you can set your watch to it. Okay, so you found a business that you can predict. Great. But here's the hard question. Is it still going to be a great business in 20 years' time? Because if competitors can copy it, steal its customers, undercut its prices, you're holding on to a melting ice cube. And that's where test 2 comes in. Test 2, does it have a moat? Buffett's most famous investing concept, the moat. Now here's his quote from 2007. Any truly great business must have an enduring moat that protects excellent returns on invested capital. The dynamics of capitalism guarantee that competitors will repeatedly assault any business castle that is earning high returns. Now the moat is what keeps its competitors away, and it's what also keeps customers coming back to it instead of going somewhere else. Without a moat, any business will get crushed over time because they don't have anything to protect it from competitors, and it's just a matter of time. So how do you spot a moat? I use MEAT. Moat, evidence, adversaries, test. So moat, what type of competitive advantage does a business have? And here are the main types. Brand, people pay more because of the name. So think Coca-Cola, Apple, Nike. Switching costs. It's expensive or painful to switch. Think Microsoft or your bank. Networking effects. The more people use it, the more valuable it becomes. So think Visa, MasterCard. Cost advantage. They make it cheaper than anyone else. Think Walmart, Costco, Amazon. Apple in 2015 had a massive brand moat and switching costs. People just didn't buy an iPhone. They bought the ecosystem that surrounds it. Their photos, their apps, their music, their messages, all in within Apple's ecosystem. If you were switching to Android or another alternative, you'd lose everything, and not many people would want to do that. Now that is a powerful moat. So evidence, do the financials prove it? So if a business really has a moat, you'll see it in the numbers. So a profit margin's higher than competitors, it's revenue growing year after year, return on invested capital above 15%. Apple's gross margins in 2015, they were at 40%. That means for every dollar that they made in sales, they kept 40% or 40 cents within the business. Compare that to most other tech companies that are trying to fight for 10 to 20% margins. Now the numbers don't lie. Apple had pricing power. Adversaries, will they be able to beat their competition? Who else is trying to win in this space? Are they getting stronger or weaker? In 2015, who was Apple's main competitor? It was Samsung mostly and a bunch of cheap Android manufacturers. But here's the thing, none of them had the brand, none of them had the ecosystem around it, and none of them had the margins like Apple did, which is easy to see the moat at work. And Apple was playing a completely different game to them. Test, will they be able to survive tough times? So what happens if interest rates go up, or there's a recession, or the currency swings? Apple sold premium items, but they weren't luxury items that people cut first during a recession. They were essential. People's lives ran on their iPhones. Even in a recession, people would find a way to upgrade their phone. And Charlie Munger put it this way: find a few great companies and just sit on your ass. And that's what a moat allows you to do. It allows you to find it once and then hold it for decades. Now look, I know this is a lot to keep track of. The 3 C's, meet framework, and we're only at test 2. Good news, you don't need to remember all of this. I've got you covered. I created the 5M framework that walks you through all this process step by step. It's downloadable and it's completely free. The link is in the description. You can download it, print it out, and you'll have the entire system for yourself. Or if you want the fast track to results, click the link to work with me, because the best investors don't rely on memory. They have a checklist. All right, you found a predictable business with a moat, but here's where most investors mess up, because even the greatest businesses can be destroyed by the people running it. And that's why you need test 3. Test 3, can you trust management? This is the test that most people skip, and it costs them. You can find the most predictable, most moat-protected business in the world, but if management are dishonest, greedy, incompetent, they'll burn it to the ground. So how do you test management? I use CAR. Candid, aligned, rational. Candid, do they tell the truth? So we read annual reports. Do they talk openly about failures? Do they explain what went wrong and how they tried to fix it? Or do they hide behind jargon, blame external factors, everyone else but themselves, and spin everything into a win? Here's Buffett when talking about finding management that is candid in the same way that a manager of a subsidiary would be candid with us. It talks in language that we can understand. It definitely improves our feeling about investing in such a business. And the reverse turns us off to some extent. If we read a bunch of public relations gobbledygook, and we see lots of pictures and no facts, it has some effect on our attitude towards a business. We want to understand the business better when we get through the annual report than when we picked it up. Honest leaders admit failure. Dishonest ones hide them. So aligned, do they have skin in the game? So how much stock does the CEO currently own? So not in the future. If the CEO's net worth is tied to the stock price, that is a really good sign. Now, if they're paid excessively in short-term incentives and huge annual salaries instead of the big carrot in the future, that means they'll optimize for short-term returns, and that leaves you hanging. So what about Apple's Tim Cook? He had significant ownership, over 1 million shares in 2015, and he created a vesting strategy to acquire the rest of the shares in his long-term incentives, but that was in a much later time period. And his wealth was tied to Apple's success over the long term. He was aligned. Rational. Do they make smart decisions about where they allocate money? This is a big one. How does the management actually allocate that cash? So do they invest in the business when it's sensible to do so? Do they give money back to shareholders when there isn't anything better for the money to go into? Or do they buy back shares when the price is below its value or above it? Or do they waste money on dumb acquisitions, empire building, and buying back stock when it's overpriced? Back in 2015, Apple was buying back billions of its own stock, and it was smart. It was buying it back when they believed it was below value. That's rational capital allocation. If you can't trust management, walk away. Doesn't matter how good it looks on paper. You found a predictable business with a strong moat and trustworthy management. Now comes the important question. Can you actually buy it cheap enough so it's a good investment? Because here's the truth. Every stock can be a bad investment if you pay too much. Test 4. Can you buy it on sale? And Howard Marks said it best. Investment success doesn't come from buying good things, but rather from buying things well. You can buy the greatest business in the world, but if you overpay for it, it's a bad investment. This is called margin of safety. You need to buy below what it's worth. Why? Here's 3 reasons. First, you might be wrong. Your analysis might have missed something. The margin of safety protects you from your own mistakes. Second, the future is uncertain. Even great businesses hit rough patches. A margin of safety cushions the blow. Third, if you buy cheap, you have upside when the price converges to value. Downside protection if things go wrong. Seth Klarman wrote in Margin of Safety, value investing is the discipline of buying securities at a significant discount from their current underlying values and holding them until more of their value is realized. The element of a bargain is the key to the process. In the language of value investors, this is referred to as buying $1 for 50 cents. So how do you know if it's on sale? You need to estimate what the business is actually worth, not the stock price, the business value. Buffett and Munger don't use spreadsheets. They use back of the envelope. Here's Buffett. Yep, it is true. If you have to actually do it with pencil and paper, it's too close to think about. I mean, it ought to just kind of scream at you that you've got this huge margin of safety. With Apple in 2015, here's what Warren Buffett saw. Consistent cash flows, massive brand and ecosystem, trading at a reasonable price relative to earnings. Plus, they were buying back stock, which increased the value of remaining shares. It wasn't the cheapest stock, but it was cheap relative to its quality and its future prospects. And that's the key. You don't need absolute lowest prices. You need a good price on a great business. Compare that to the dot-com crash in 2000, where people were paying 100 times earnings for businesses with no profit. Those weren't investments, they were bets. And Howard Marks writes, no asset is so good that it can't be bid up to the point where it's overpriced and thus dangerous. And few assets are so bad that they can't become underpriced and thus safe. Price is everything. Now, if you want to learn exactly how to do this and value a business in a margin of safety, I've created a 7-day challenge for you and it's free. It walks you through this entire process. The link is in the description. Because the investors who win aren't the ones who guess. They have a system. All right, you've passed 4 tests. You've found a predictable business with a strong moat, with good management team at a good price. 1 test left. And this is the test that separates good investors from great. Test 5. Is this better than what you already own? This is the discipline test. Just because a stock has passed your 4 tests doesn't mean you should buy it. You need to ask, is this better than what I already own? Warren Buffett said, the enemy of investment success is activity. Most investors trade too much, they get bored, and they want to do something. But great investors are patient, and they only act when they find an exceptional opportunity. And Allan Mecham said, we exercise patience and discipline to only invest in exceptional opportunities. So here's how to apply test 5. Discipline. Can you hold it for 5 years minimum? If not, don't buy it. You're not investing, you're trading. Every time you sell, you pay taxes and fees, and those costs compound against you. Seth Klarman said, single greatest edge an investor can have is a long-term orientation. Exceptional. Would you put at least 10% of your portfolio in this idea? If you're only willing to put 1%, you don't actually believe in it. Concentration forces you to have real conviction. Buffett again from 1996. Diversification is a protection against ignorance. That is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you've done the work, you don't need 50 stocks. You just need your best 6 to 10 ideas. Hone. Does this stock give you better risk-adjusted returns compared to what you already have? Compare this stock to your current holdings and rank them. And if this new stock isn't in your top holdings, why are you buying it? Either this replaces something weaker or you wait. This is how you raise your standards over time and your returns, by only investing in the best opportunities. And that's how Buffett ended up with Apple in 2015. It wasn't just good, it was the best opportunity that was available at that moment. So there you have it, the 5 tests Buffett uses to find the top 1% of stocks. Test 1, can you predict it? The 3 C's. Test 2, does it have a moat? The meat. Test 3, can you trust management? The car. Test 4, can you buy it on sale? The margin of safety. Test 5, is this exceptional? Maintain your standards. Most investors skip these tests and they buy from hype, tips, FOMO, and that's why 99% of stocks fail them. But if you use this system, you'll be in the top 1% of investors that actually build their wealth. Your homework, pick one stock that you currently own or that you're looking at in a watch list and rank it through these 5. And be honest, does it actually pass or doesn't it? And if not, why are you holding it? Don't forget, you can grab that 5Ms and the other free resources in the link in the description. They're there for you to help. If this was helpful for you, click subscribe and drop a comment below. What stock are you actually going to use this on first? Now here's the thing, finding a great stock is only half the battle. You also need to know when to sell it or hold it, because holding too long can cost you just as much as selling too early. That's why you need to watch this next video where I cover the 6 scenarios that trigger a sell decision, how to avoid the break-even trap that destroys wealth, and how most investors sell at exactly the wrong time. If you just learned how to find winners, now you need to learn how to hold them and when to let them go. Click the link on screen to check it out. Thanks for watching. Get after it, guys.